2025 will go down as a test of strength for Indian markets. Despite record foreign selling and global uncertainty, domestic flows and local investor confidence powered the markets this year. Foreign portfolio investors pulled out nearly 1.6 trillion rupees or about $18 billion, marking the highest annual outflow on record. Meanwhile, concerns over stretched valuations, subdued earnings growth, geopolitical risks, and uncertainty around the US tariffs weighed heavily on foreign sentiment. Information technology stocks bore the brunt, accounting for almost half the outflows, with the index falling nearly 12% amid weak client spending and macro uncertainty in the US. In fact, despite this, benchmark indices held firm, with the Nifty 50 and Sensex rising about 10% each, supported by strong domestic buying. While foreign investors exited, domestic institutions stepped in aggressively. Total domestic inflows hit a record $86 billion in 2025, cushioning volatility and preventing deeper market corrections. This surge in local participation has reshaped market ownership. By the September quarter, foreign ownership of Indian equities fell to a 15-year low of 16.9%, while domestic mutual fund holdings rose to a record 10.9%. Small cap stocks declined 6%, weighed down by weak earnings and premium valuations.
The positioning by the foreign investors remains more dampened. I don't think the selling is done yet. It will stop and it will change into net inflows once the earnings revive. Just to put it in perspective, FPIs are holding about $900 billion of Indian equities. So out of that, $18–20 billion going out in a year is not that big an issue. Historically, it might be at record levels and all that, but that's because the size of the market has increased, the levels of the market have increased, but this is hardly about 2% of their total holdings.
And 2025 also saw pressure building on the Indian rupee. The rupee weakened against the dollar through much of the year, making it one of Asia's underperforming currencies in 2025. But despite intervention by the Reserve Bank of India to smooth volatility, the weaker rupee fed into foreign investor caution, even as it provided some support to export-oriented sectors. Looking ahead, expectations are building for a stronger 2026. Analysts point to easing valuations, a likely recovery in corporate earnings, and a solid macroeconomic backdrop. Hopes of the India-US trade deal, easing inflation, accelerating public capital expenditure, and rate cuts could also revive foreign investor interest.
Next year, we are looking at a triple catalyst. First is earnings revival. So it will be an earnings validation year from a valuation concern year. Second will be the union budget is expected to bring in more big bang reforms and stimulus. So very high expectations around union budget. Third will be the trade deals being finalized with both the EU and the US. Our hopes are high for those as well, that eventually over the next year we'll get to see. So these are the triple catalysts which are driving the markets.
While a sharp rebound may be unlikely, experts expect selling pressure to moderate and foreign interest to gradually return after a year defined by domestic strength. The stage appears set for a more balanced market in 2026. To stay up to speed with the latest news, download the WION app and subscribe to our YouTube channel.